Hi everyone, I'm Kyle Bechet, and this is the AAF Exchange, a podcast from the American Action Forum, where experts provide clear, data-driven insights into today's economic and domestic policy issues. Welcome, and thank you for tuning in. On this episode of the AAF Exchange, the global economic outlook, energy market mayhem, and Trump's tariff exemptions. Joining us to break all this down are AAF President Douglas Holtz-Eakin and, later on, Trade Policy Analyst Jacob Jensen. Doug, thanks for joining us.
Thanks for having me.
So, what's been on your mind recently?
Firms that don't pay taxes, or at least claims about firms that don't pay taxes. So there's a group called ITEP, and they put out the same report year after year after year. And this is the report that President Biden quoted twice in the State of the Union, saying there are 55 of the most profitable large American firms that don't pay any taxes. And it's infuriating because it's not a good quality report.
Yeah.
So, issues. Number one, they don't have access to tax data. Tax returns are confidential. So they are making up the tax status by looking at the 10K and guessing. So not a good start. Second, there are big firms, profitable firms that don't pay any taxes because they take advantage of things the Congress wanted them to do. So if you do a lot of investment, you get to deduct the full cost of that investment in the year you make it. And so you got $100,000 in revenue and you do $100,000 in investment, you have zero taxable profits. Pay no taxes. That's what Congress wanted you to do. Or you're a utility, you have thousands of green energy credits from your solar fields. That's what Congress wanted you to do. You don't pay any taxes. So I could go on,
right?
But you're complying with the tax law and doing the things they wanted you to. But it's being presented as if you're somehow dodging your taxes.
Yeah.
And then there's a big difference between financial profit accounting and tax accounting. Taxes are cash flow. They are what happened in this year. Money came in, costs went out, pay the difference. If you drill for oil and suddenly you've got an oil well, in the year when you do that, you realize all those future profits and put them on your profits. Yeah, they haven't shown up yet, and you're not going to pay taxes on them yet. Mm-hmm. So it's the timing issues. And then loss carry forwards, loss carry backs happen in the tax world. They don't happen in accounting. I might be able to go on, but I should stop. The basic point here is nobody's breaking the law.
Yeah.
And it's portrayed as nefarious. They're doing something wrong. They're evil big companies. They're just following the rules.
Mm-hmm. I think what for me, it's always this line always lands well with portions of the electorate because nobody understands the tax code.
Yeah, no, I get it. But it's just not research. It's a hit piece.
Right.
Come on.
Yeah.
and of course, the companies are selected randomly. Let's pick the one that the Secretary of Energy used to run.
Yeah.
Okay. That's the game.
Right. So, I mean, it seems almost inevitable that this week those things are going to happen. I mean, it's tax week, April 15th. So there's a lot of inevitabilities here in D.C., and we're getting two of them in the same week where the heat returns and and tax day happens. Yes. So, anyways, I had a feeling that was going to be on top of something tax related was going to be on top of your mind.
It usually is.
All right. So another thing that's happening this week, it's IMF and World Bank are holding their spring meetings here in DC.
I want to get punched up and angry about the traffic. How's that? How about that?
I was wondering if what was going to be on top of your mind was going to be heat or traffic, and
they're both there.
and just lost out by taxes, which
it was close.
For you, I think that's probably what is usually on top of your mind. But anyways, it's this week, so we figured let's do a podcast about international economy. So let's jump into it. So let's start here. How would you describe the current global economic outlook?
Highly uncertain, and we all know why. How long do the hostilities last in the Middle East, in Iran? So, the quote news out of this, which is not news to anyone who's paying attention, is that the IMF marked down their forecast for global growth because of the oil shock. And so U.S. growth, I think we've probably knocked a half to 3/4 of a percentage point off this year. And we're the best positioned to survive something like this. We're a big oil producer, so we benefit as well as get hit by it. our natural gas market's insulated from the rest of the world. So if you start walking around the rest of the world, you're getting much bigger impacts. We're already seeing the Asian economies ration energy because they're not getting enough natural gas. They can't get it out of the strait, and so they got problems. Europe's still getting it, but the price is high. They've marked European growth down to 1.1% for the year. And then there's the high oil prices. Those countries are more exposed to that. So why is it highly uncertain? We don't know how long any of this is going to last. And there's a big difference between a genuine oil price spike that goes away and a sustained high global energy crunch. And that's the issue.
So, let's break all this down a little bit. One of the things that I think you talked about earlier this week over at the IMF, you did a panel and things like that. So what do the dollar relatives weakness and the uncertainty about the sovereign wealth fund mean for the United States?
So the U.S. has been downgraded 3 times now, and it has had some episodes that suggest people are not uniformly confident in the dollar's safety and soundness. It's always been the bedrock of the international financial system. After Liberation Day, we saw a flight from the dollar. That was shocking. And now the developing companies, sovereign wealth sovereign wealth funds are expressing concern and are diversifying away from the dollar to some extent. They aren't refusing dollars, but they are sort of openly concerned about the future and whether they want to have their resources in dollar-denominated assets. That's a huge sort of indictment, I think. Now, it's not the largest of our trading partners or anything like that, but it's a real thing. And the chatter in financial markets picked this right up. And no one thinks that we're going to have credit risk on treasuries, but there is a lot less belief in the sort of flight to safety that the dollar won't fluctuate much. You'll be okay. Yeah. That's where the concern is.
So just so I'm clear, what the sovereign wealth funds, just remind us what they are and how they sort of interact with the U.S. economy.
So the classic sovereign wealth fund is Norway drills in the offshore oil fields, sells it on the global market, takes the proceeds and puts it in a big account, which is their sovereign wealth fund. So they've transformed their oil wealth into financial wealth, and then they invest around the world in all sorts of things and use that to finance their infrastructure and some of their pension plans. So these sovereign wealth funds are especially mineral-rich countries transform that into financial wealth and then investing it for financial returns so that they can finance their programs. And that's a strategy that many of the developing countries that have more resources than they have mature industries, they'll do that.
Gotcha. All right. So you started alluding to it with the global unrest. Of course, the big part of it is the economic picture. Is the energy markets.
Right.
I mean, we've all seen the pain at the pump recently. We're watching the crude oil markets on almost a daily basis. So what's going on there?
Pretty simple. We've seen essentially complete stoppage in the Strait of Hormuz, which is about 20% of global oil and 20% of global natural gas supplies. That's a big supply shock, and prices respond accordingly. And you get different results in oil and gas because the oil markets are well integrated, and so prices go up everywhere. Oil flows from one market to another, so the prices can't stay different. It's going to flow to the place where they get the highest price, and so you get these sort of very uniform impacts across the globe. Natural gas is not that. There's essentially the North American market, which is, even it is not completely integrated because we can't get natural gas to the Northeast because of the New York won't let a pipeline go through. So we have things like that.
Yeah.
But we have the North American market, and and then we've got the European market relatively well integrated, and we have Asian markets. But those 3 big zones aren't connected at all. And so what we've seen, it's really a remarkable picture. Shu-Ting Pomerleau has a paper in which she sort of graphs the prices of natural gas, and the U.S. line is flat. Hasn't moved a bit since the hostilities started. We're separate from that world, and we are unaffected by it. We had a spike in prices in Europe and in Asia. And in Asia, they're now getting it. They're getting the actually rationing. They're just saying, look, you can't have it. Switching things to coal fires and stuff like that.
Yeah. So it was like probably one of my favorite. I think you said one of our favorite graphs that you put
Everyone
out.
should have a favorite graph, and that's mine.
Yeah, maybe, yeah. But another big part of that paper was, okay, so why can't the U.S. just completely, start exporting our? And the answer is it's incredibly hard to do that from a logistics standpoint.
It's you have to liquefy, you have to have the export facilities, and we have a finite number of terminals, and they have to be able to receive it, and so the physical infrastructure to integrate it is a big investment.
Interesting. So do you see this as more of a short-term shock or long-term, or does it depend?
I hate to say it depends, but it does depend.
Yeah.
We don't know how long it's going to last. That's a diplomatic statement. It's also a sort of infrastructure statement, because it could be that the Iranians have inflicted some fairly serious, long-lasting damage to production facilities in the Middle East. If so, even if the supplies start flowing again, it might take longer to get the original production back.
Yeah.
So that's why it's really just sort of depends on how quickly the strait gets opened up and the hostilities cease, and what kind of damage is left behind.
Yeah, the reason I asked is because last week, I think yesterday or the day before, I saw Secretary Besson out talking about how they don't even see how oil, like the price at the pump, is going to go down to pre-war levels in a year from now, which, so,
Yeah, I'm not going to get in that game. We'll see.
Yeah, I mean, it really does seem like it depends on. Is there anything policymakers should be doing right now on the energy front? On the energy front?
Well, I mean, they've done the one thing they can do, which is to tap the Strategic Petroleum Reserve aggressively worldwide. Yeah. So we've really had a modest fallout from this because of that, in my view. The rest of it is really, you solve high prices by letting markets work and generate more supply. And if they start interfering and start saying we're going to control prices, put price caps on, do windfall profits taxes, do all the stupid things that we've done historically, they'll make things worse. But by and large, this is a deal with the problem, which is the status of relations between the United States and Iran, and the rest will clean itself up.
Yeah. All right. Well, on that note, it's time to do a trivia question.
Okay.
It's been too easy recently.
It has never been too easy, Kyle.
So I am now so we're gonna do something that another podcast does that you like, and I'm just gonna give you a number, and you got to tell me what it is.
Okay.
302 billion.
302 billion.
Give you a hint. Dan Goldbeck just wrote a paper on this week.
Is that the regulatory costs so far this year?
Yeah, it's the total cost of tax paperwork burdens.
Oh, yes.
So
of course.
He wrote his annual tax day regulatory burden paper, and that was the number that...
And it's not going down. It's just disappointing.
Yeah.
The goal was simplification, and it's not simpler.
Mm-hmm.
I mean, the sort of no tax on tips, no tax on overtime world is one that you actually have to do a lot of work.
I was going to say it might have created more accountants out there.
I was never a fan for those reasons. I mean, the tax economist in me looks at that and says, okay, this is a lot of compliance burden, a lot of administrative burden, a lot of distortion of economic decisions, and to what economic end? Not much.
Yeah. Doug, thanks for joining us.
Thank you.
Jacob, welcome back.
Great to be back. It's been a while.
It's been a little while, but I finally got you back on. I mean, trade has been in the news quite a bit.
Oh yeah.
So I'm pretty much gonna have you on every week. So we kind of have to like pick our days to do it, our times to do it. But you just had a great paper out this week, so it seemed like a perfect time to get you back on and talk about it. So your new paper walks through the administration's tariff evolution. What's the latest?
Yeah, so it's organized kind of into 3 key chapters: the past, the present, and the future. So the past, as many people know, there was the AIPA regime, which culminated on Liberation Day. Those tariffs are now gone since the Supreme Court struck those down in February. At its height, it was like a 22% effective tariff rate, which is up from the historical average of 2%. And that is now it was at 14% before the Supreme Court struck it down. Mm-hmm. Now, the few days after that decision, the Trump administration imposed a new tariff regime using Section 122, and now we're looking at an effective tariff rate of 10%, so a little bit lower than the AIPA regime. Yeah,
so I know this wasn't part of your paper, but part of that whole Supreme Court thing, of course, is now like the logistics of how do you pay back money and things like that. Is that sort of happening in the background?
Yeah, that's been somewhat of a messy process, but it looks like by the end of this month, refunds are going to start going back out to U.S. businesses.
Interesting. Well, I'm sure you'll have to keep an eye on that, and your shipment will have something about it once we know more.
Right.
Which is a great piece, and everyone should go sign up for it. Just to do a quick plug for you.
Yeah.
Anyways, so President Trump has granted a lot of exceptions to these tariffs. So I think you said it, they're hollowing them out essentially. So talk to us about who or what is getting these exemptions and why.
Yeah, so during the AIPA regime, that's when the exemptions really first materialized. Towards the end of it, they started exempting critical minerals. Agricultural products was a big one because consumers were starting to complain about the price of coffee and the price of beef. So, and then electronics was another big category that was exempted. So consumer-facing products to kind of mitigate the tariff cost impact on consumers leading up to these midterms
has really helped. Yeah. So I mean, so it seems like it's a little bit of picking winners and losers to help smooth over some of these tariffs. And we are facing an affordability crisis, according that everyone talks about. So it helps with that things as well, right? I mean, that's what it seems like to me.
And it seems like the administration is only, continuing on these exemptions. The 122 regime doubled down on the exemptions from AIPA and expanded upon those. Mm-hmm. So we're looking at about 60% of U.S. imports are actually exempt from the 122 tariffs.
Interesting. So basically, everything that's not exempted is basically some national security issues and things like that.
Anything not exempt is either hit with these 10% 122 tariffs or the 232, like you said, national security tariffs, which can range from 25 to as high as 50%.
Interesting. And then is there? I remember back when we talked before that the AIPA tariffs really hurt small businesses. Is that still the case? Are we with these hollow out exemptions? Are we favoring the larger firms over, and small businesses are hurting, or is that sort of not an issue as much?
Yeah, a lot of the larger businesses are those that are benefiting from these exemptions. A lot of the big tech companies benefited from the semiconductor and electronic exemptions. Small businesses don't have the lobbying power to, request these exemptions. They don't have the manpower to kind of go through and fill out these forms. And we're even seeing with the refund process that a lot of them are being left out of that process because they're not actually signed up for the program.
Interesting. All right, so we've talked past, present, so let's talk about future. What should we watch for in the coming months?
Yes, so these 122 tariffs that I mentioned are temporary. They last only 150 days. So that puts us at an expiration date in around July. So the administration is going to have to decide, are they going to try to attempt to renew these tariffs unilaterally, or are they going to go to Congress to ask for a 150-day extension? It seems unlikely to me that Congress will want to extend these tariffs given the midterms and, like you said, the affordability crisis. So that leaves the administration with a third option, which is rely on the national security tariffs, the 232s, and other authorities such as 301.
Interesting. Well, that'll keep you quite busy throughout the rest of the year then. So Thanks for coming on and talking about your paper. We'll, of course, include a link to it in the email and when this goes out. And hopefully, we'll get you back on sooner next time.
Looking forward to it.
Thanks, Jacob.
Thanks.
I hope you enjoyed this conversation. Tune back in for our next episode, where our experts will provide clear, data-driven insights into today's economic and domestic issues. I'd also encourage you to check out any of the links in our show notes, and also follow us on social media to learn more about AAF. Don't forget to subscribe on iTunes, Spotify, or Google Play.